With the Fed waiting to cut until September, will it be too late? Let's go. I've been off for a couple weeks and man, I've sure enjoyed it. And since then, the market's tone, well, it went ahead and it sure changed. Now, this week came up for air, but saw more selling as we went into the end of the week. Let's look at deeper where we're going to go from here. Last time we met, when I did a video a few weeks ago, I said that likely I thought the top would come in somewhere around 565, and lo and behold, it came in at 565.16. Now, I'm not bragging or anything that I pretty much nailed that one to the penny. If you don't believe me, then check out my last video or my Twitter feed, or better yet, join the Discord. Before jumping into SPY Weekly, I think it's important to note that we finally are seeing stocks and bonds no longer trading in the same direction. And bad news is finally bad news. When jobs missed expectations, the base case is now that the Fed is going to wait too long, causing a recession, which means the market for now is heading lower. We're going to spend some time today talking about this weekly bouncing into this 20 simple moving average and what we can expect, as this area is super critical. If we likely bounce here, we're likely to put in a dead cat bounce before moving lower. But if we rip right through this area, support is much further below. Being that the VIX was up crazy today, and at one point it actually approached 30, this is telling us that we are more likely next week to have a dead cat bounce instead of just dropping through the critical support area of the 20 simple moving average. Now, something that you don't see too often here is that the 50 exponential moving average is trending with a 200-day simple moving average, and we have the lower Bollinger Band all pretty much clustered here, riding together, forming a strong area of support. And we can see that this cluster of events is lining up pretty nicely with a well-defined neckline here. We have a left shoulder here with the presence of a head, and we're not exactly sure what's going on here yet, to be determined. But one thing for sure is that if we don't bounce in this area higher before moving lower, if we gap through this area, right now we're likely to continue moving lower to form the head and complete that head formation before likely putting in a right shoulder. One thing I always include on the Discord is next week's economic calendar, amongst other things. And you'll see here that really next week we have some ISM services and maybe the trade deficit, but there really isn't a whole lot going on besides initial jobless claims on Thursday. So this tells us that more likely the trend is your friend until the very end. And right now, if I look at the lower time frames, I'm not seeing any type of reversal patterns on the daily or the hourly at this point. So to me, a 20 simple moving average just really isn't a reason just to randomly bounce. I think we're more likely to continue that trend lower unless something gives us a reason to change. And over this weekend right now, you're hearing about how Iran maybe wants to attack this weekend going into Monday. So unsure if that starts factoring into the market, how it will impact things. Another thing that you'll notice on the weekly is, once again, we've seen a cross of the MACD below its signal. And typically when this happens, the stock market will want to at least contemplate moving lower. It's not to say that we couldn't start just moving sideways before moving lower, but likely, these things typically, once they cross, it's not like we're just going to have a rip-roaring rally higher. So it's something to keep an eye on. So if we do see something moving sideways, likely this is some type of corrective that over the course of weeks will be up and down and up and down. Something similar to what we saw, maybe in this area here, where you saw we got the MACD cross and then it went a couple weeks sideways, giving the illusion of retracing here, but then moving lower one week, then higher and lower, in order to go ahead and fulfill that breakdown moving lower before bouncing to wave 4 and then wave 5. But you can see here that many times when in an uptrend, the 20 simple moving average is the bull trend trend, and you likely bounce higher before moving lower. We saw it again over here. Went ahead and moved higher. And if we went back and looked in time, you'll see that this is very normal behavior, hitting that 20, moving higher. In this case, we went ahead and put in a divergence where we moved higher before then making the first move lower. Now, if we flip over to the Qs, one thing we notice here on the Qs is that we already did lose that 20 simple moving average. And if this 5 exponential moving average does cross below that 20 simple moving average on the weekly, that is going to indicate that we have a trend change. So this is giving us the idea right now that since we lost that 20 simple moving average, unless we just go ahead, early next week and just pivot and change with virtually no reason on the calendar to do so, we're likely to come back into this 200-day and 50 exponential moving average area. And I'm not saying all in 1 week, but we're likely to go ahead and cut through this at some point over the next couple of weeks and spike this area, which would align with this neckline, and it would complete the head formation of the Qs. Now, the reason why the Qs are important to SPY is normally we would see this bottom first and start to bounce before the SPY does so. So we'd expect this to be running ahead like it normally is, even on the way up. And right now, this is running ahead, which means over the next couple weeks, we'd likely see this momentum continue more to the downside, especially when you see that the sell volume has been increasing week over week. This isn't going to tell us that all of a sudden people are going to start buying. Since semiconductors and namely NVIDIA really have been driving a lot of this price action, if we flip over to NVIDIA, if we use this for a second opinion, and I went ahead and added that neckline, we did indeed bounce and hold this 20 simple moving average. So this is giving us a little bit different information than the Qs. So are we going to go ahead maybe and put in a lower high, or maybe even a retrace here to go higher before moving lower? But one thing for sure is that even on NVIDIA, if we lose this 20 simple moving average, we're likely to go ahead and move lower and spike through this 250 exponential moving average area, which would line up with this neckline. So it's something we have to keep an eye on here. Now, flipping over to the small caps, this is something that I had a lot of hope for, especially if we had a soft landing trade, but those hopes are seemingly becoming somewhat dashed now that the Fed is holding higher for longer. You can see that this week we were down almost 9% peak to trough on the close of this week. So this isn't, giving us a warm fuzzy that all of a sudden this could be a breakout trade like we thought once before with the soft landing scenario. Now, if we look back in time, we can see that, this is an area of at least some decent support here. So, could this maybe bounce before moving lower? But at this point, it feels like we're more likely to spend some time mimicking what we saw here with a left shoulder, and likely continuing moving from left to right as the market tries to sort out whether or not, we're in recessionary type behavior. Something that you don't hear a whole lot about was the SOM rule, and that went into effect, and I think it's literally predicted every recession properly since I don't know how long. So, the idea here now is something to think about moving forward, as we've seen, quite a few increase in job losses, and all of a sudden with earnings, we're not seeing companies necessarily just completely knock it out of the park. I mean, some of big tech is doing okay and still getting hit somewhat because, now all of a sudden they're not making the earnings on top of earnings that the MMs thought they would. But a lot of especially retail influenced companies are getting it put on the chin a little bit as revenues seem to be decreasing and the consumer is weakening. So being that we were in this range for so long, it wouldn't be abnormal for us to come back down into this 200 area and retest the breakout before moving higher. The only thing that we got to think about also from a fundamental standpoint is that all of a sudden, if we're getting nervous that we're going into recession type behavior, these 2,000 different stocks normally don't fare too well during that type of an environment, even if interest rates are heading lower, like the market has shown the US 10Y, and we'll look at that a little bit later, pretty much falling through the floor. Now, if we go ahead and look at Bitcoin here, we'll notice that once again, we came into that 70,000 area, and we went ahead and since then have dropped almost 14% this week. So the ultimate risk asset is all of a sudden saying risk off. Right now, we've pretty much sliced through this 200-day simple moving average, which means that, as we come to the lower side of this Bollinger Band, are we going to go ahead and maybe come back down to this 50 exponential moving average before maybe getting some type of bounce? Or is this some type of accumulation where we're going to actually, move higher, which you would not think so because you would have thought this would have been the spring here. So, at this point, are we likely to maybe with nothing on the calendar just continue to move lower as the MACD has been below the signal for quite some time here? When we look at high risk assets like ARKK ETF here, we notice pretty much it's been circling around this 200-day simple moving average for quite some time, and 45 kind of has been, hey, whether we should feel bearish or bullish on this one, but no joy of a bounce here in moving higher off that 45. Instead, this one all of a sudden has put in quite a sell candle here in the last week, which means, likely we're going to head lower before we come into some type of support and bounce it higher. And again, all of this going on with earnings, which so far I haven't looked at the complete earning results to understand the beats, but it's not feeling that great with a whole host of companies out there. So this one, feels like there's some trouble ahead. The US 10Y yield finally rolled over, but at this point, did it roll over too hard? And let me explain. So what we'd normally like to see here is something where, interest rates steadily decrease. And of course, this would allow bonds to, in the inverse, move higher. But being that we saw such a strong move to the downside, what this is saying is that they think the Fed is holding on too hard and too long to keep interest rates too high. So what they're saying here now is that, hey, by the Fed holding too high for too long, they're going to break something, and they're going to have to make multiple cuts going into the beginning of the year because either we're in a recession or maybe banks start to fail or something else starts to happen. They broke something and they got to respond quickly. So this is actually becoming good news if you're in bonds all of a sudden, because bonds are going to do the reverse. And that's a trade I've been making some money on. But, the problem is for equities, what this is saying is it's a sell signal. Because if we look at bonds, what you'll see here is look how that volume all of a sudden increased. So even if equities are dumping, bonds are going to become a flight to safety. And this one still isn't too late to get into its XXX leveraged, fund TMF, which will move 3x higher for every percent this goes higher. So this was up 5% this week, which means the TMF was up over 15% this week. So it's not too late to get into this one, because if you look back in time, how much this TLT trade has gone down, it's going to be very safe. Even if they cut interest rates, this thing is going to keep moving higher and keep pressing higher. So this one here, even if it comes back down a little bit to earth, it's likely just to take off again. Now the VIX, if we look at this one, and you can see here, I have a measurement from where we started the week to the high of the week. And if we look at where we topped out at one point this week, this one on Friday was up almost about 80% on the week. Now on the week, we still closed up about 40%. And this is just gangbusters crazy as a ton of volatility has come back in as we're going into an election, which I would expect will probably only continue to increase volatility going into that event. And for all those people that said the VIX was broken due to zero DTE contracts, I think we can now say they were just wrong, as that AI trade really was just going ahead and crushing all fear in the market and pumping equities higher. But the one thing I have to mention here is that once we get into a VIX that's above this danger zone of, let's call it 20, it gets really tough to go ahead and swing trade with sometimes these type of volatile events, because you could be up real high one day and just reverse it the next day. So volatility works in both directions sometimes once it gets this high. So it's something really to keep an eye on here moving forward. And on that note, thanks for joining, as that's all I have for now until the next video, and we'll see you then.